Hi, thank you for joining me at this exciting educational event. I am excited to talk to those of you who are real estate investors and those who want to be real estate investors about our program on how to pay the least taxes legally possible while growing your wealth exponentially. So let's get started. Greetings from me, Bill Knoll. I'm an attorney and CPA. I am a speaker. I'm an author. I'm an investor. I'm also a landlord. Welcome to our complete path to getting richer quicker by avoiding demons. Those are taxes, the IRS, and unfortunately inept tax advisors. So why should you listen to me, Bill Knoll? Who am I? Well, I am an attorney and I'm a CPA. I am a national speaker. I am also a landlord, a property manager, and an investor. As far as my experience goes, I began working in accounting in the CPA firm that was founded by my father in the 1980s. Following college, where I majored in accounting, I went to law school, and upon graduation from law school, I became a prosecuting attorney. After about 3-4 years as a prosecutor, I then went into law practice and became a partner, handling all matters of litigation, criminal defense, divorce, commercial litigation, personal injury, etc. I was often selected by judges to handle difficult assignments such as large-scale criminal indictments and corrupt organization cases. For the last 10 years, however, I've limited my practice to tax and business entities. This program was designed in conjunction with my dear friend Al Ayala, who unfortunately passed away a year or so back. I want to tell you about him because he and I worked on this together. He was also a national educator. I've been speaking to real estate investor groups since the 1980s. A real estate investor. He was a CPA and passed the first time, which was incredibly difficult during the 1980s because you had to take all of the parts at one time. He then obtained a master's degree in taxation, and upon graduation, he was immediately asked to become a professor. And one of the first classes that he put together was a class on real estate tax issues, which was sort of the germination of this program originally. He also had a real estate-focused tax preparation practice. We are going to teach you today powerful tax strategies for real investors that will save you thousands of dollars per year. I hope you're as excited as I am to get started. You know, Al and I stay up at night reading the tax code, so you don't have to. First thing I want to tell you, 95% of CPAs, and that's probably yours, do not know how to reduce your taxes and reduce the chance of an audit of your return, which causes you frequently to pay too much in taxes and have big problems with the IRS. Second fact, just about all real estate investors' tax returns are done wrong by either overpaying taxes or creating high audit risk or having both of those things happen. Third fact, taxes are your biggest expense, and without planning, they will drain you. It's what you make after taxes that really counts. As I say, it's not what you make, but what you'll keep that ultimately determines your wealth. This program is all about making money for you after taxes, growing your wealth exponentially, which will give you the ability to pass huge amounts of real estate equity onto your heirs. Of course, the purpose of our program today is to show you how to increase your cash flow after taxes, taking that into account. I'm going to teach you how to save taxes every year, how to avoid the possibility of an expensive IRS audit, how to identify and avoid costly advice from CPAs that don't know what they're doing. Ultimately, you want to control your money. I want you, as you listen to this program, to realize that you need to be the captain of your ship, the real estate ship, and not the first mate to your CPA or other tax preparer. You're going to learn today about a low-risk, high-return money-saving strategy. And all types of real estate investors will benefit from this no matter how. So long as you're engaging in real estate-related activity, you will learn how to reduce your taxes and save money. So the first thing I want you to understand is that the best, fastest, and safest way to accumulate wealth is through having a single real estate portfolio that holds both what we call keepers or rentals along with flippers. Those would be things that you fix and flip, remodel, wholesale, etc. These things feed one another with money-saving benefits in so many ways. This double play wealth building phenomenon becomes even more exponential once you combine that with the gold mine tax saving strategies that I'm going to teach you today. By the way, for those of you who listen to the end of this program, you'll learn how you can send your tax returns to me to review your returns to see whether you could amend your returns and get a large refund, and also to teach you whether your returns are being done properly by your current advisor. So be sure to listen in to the entire program today. Here's what we're going to teach you about. We're going to explain to you that your rental properties assist you when you are flipping properties. So your rental properties can generate tax losses primarily through the use of depreciation, which is a non-cash expenditure, to offset the profits that you make on the flips, and that generates substantial tax savings for you. The holding of rental properties demonstrates that you are an investor and you're not a dealer on these flips, demonstrating that you have what's called an investment intent. Dealers are taxed at much higher rates and have worse tax situations. Now, conversely, when you are flipping properties, you can use the profits from those flips to feed the investment needs of your rental portfolio, such as holding an emergency fund, having a capital reserve fund, improving your rental portfolio to generate additional cash flow, as just a few examples. By having the rental properties, you are again demonstrating that you are an investor to avoid being called a dealer by the IRS and giving you the worst tax situation you can be in. Ultimately, so long as you're an investor, you can also learn how to dispose of properties tax-free and substantially reduce your investment risk going into the future. Of course, the specific tax saving strategy that you utilize will depend on the type of real estate investing you're doing. But we are going to teach you how these strategies can play and intermingle with one another. So first of all, if you're a rental property owner, you should increase your componentizing non-cash depreciation expenses, which generate paper losses and reduce your other income, ultimately having tax savings. After identifying the tax losses that are created by your rental portfolio, you're going to sidestep the IRS passive loss limits to fully deduct these losses against the other income that you have for huge tax savings and greater cash flow each year. When you're doing wholesale or flips, the first thing you need to do is avoid being considered a dealer. Then you use these strategies to sell the properties that you're flipping tax-free so that you get to keep 100% of the profits. These strategies are going to be covered in this presentation today. But before we get into that, I want to talk to you a little bit about CPAs and what most people don't realize. The first thing I want to point out is that the AICPA is a wonderful advertising agency for CPAs. That is what they do best. They make people feel like CPAs in general are the best tax preparers. The fact of the matter is about 15% of the CPA exam actually relates to taxes. So just because someone has passed the CPA exam does not really mean that they are an expert with regard to taxes, and it certainly doesn't establish that they have knowledge with regard to tax strategies revolving around real estate. The fact is most CPAs don't work on any Form 1040 other than their own, and the vast majority of CPAs have never been trained to do research on tax law. That typically only happens in a master's program. It does not happen in an undergraduate accounting program. In fact, I have a current client whose former CPA used Wikipedia to look up a tax regulation. That person got bad information from Wikipedia and made an irrevocable election for the client, costing my client $70,000 in unnecessary taxes. So you have to be confident the person you're working with knows how to perform tax research. As a matter of fact, I'm someone who will admit that you never really know the correct answer to a tax position unless you get audited. Most tax returns are accepted by the IRS without review, and therefore, until an audit happens, there's no absolute certainty that the position taken is correct. The vast majority of CPAs will substitute their risk tolerance for that of their clients. If they're conservative by nature, they will be conservative and suggest that clients cannot make certain deductions. On the other hand, if they are aggressive by nature, they will tell people that they can take deductions that they really aren't allowed to take. So what you want is someone who can engage in a dialogue and help you decide what your risk tolerance will be on your tax return in a particular tax position. Most CPAs want their clients to be intimidated by their credentials, and the vast majority, the very vast majority of CPAs have very few clients who invest in real estate. Now, there are strategies that all real estate investors should do to reduce the possibility of an audit on your tax returns. You know, even if you win in an audit, the time, expense, and headaches created makes you lose in the long run. So one of the first rules of tax preparation is try to avoid an audit. And here we go. Don't get audited. Best rule for tax reduction. An IRS audit drains you in lost tax savings and legal fees, lots of stress. Our program is going to show you 30 ways to audit-proof your return to keep the IRS out of your life. I hope you're excited to learn about more. So we're going to jump ahead now and talk about depreciation. If I'm teaching a live event, I engage in a dialogue with people, and I ask them what is depreciation, and I typically get answers such as a way to decide how long a property is going to last. It is the ability to deduct the loss in value of property as it gets older and wears out, answers like that. Those are, in fact, general and decent answers, but the point that I always like to start out with when teaching this program is that the Internal Revenue Service considers depreciation to be a form of an estimate. Now, once you understand that calculating depreciation is a form of an estimate, then it becomes easier to realize that since it's an estimate, there may be different ways to calculate depreciation. And that is what I want you to understand, is that although there are certain rules with regard to what they call the recovery period or the life of the asset, the manner in which you decide how these assets are listed is an estimate that's up to you and your tax preparer. Our first goldmine tax saving strategy for rental property owners, and those who should be, especially those of you who are doing wholesaling, flips, and rehabs, is to use our componentizing depreciation. Another term for that is cost segregation, to accelerate wealth by doubling and even tripling your depreciation deductions. Of course, depreciation doesn't cost you any cash. It's not money out of your pocket, yet they generate significant tax savings through the rental losses that can be created in depreciation. The problem, most CPAs do not know or choose to dramatically increase your non-cash depreciation deductions because they use the old-fashioned 80-20 method. So we're going to talk about right now a property with a $100,000 cost, and typically Pistol Pete tax preparer would have a land value of 20% for the land, and then we'd say that the building would be 80%. So you would have a value of 80% for the building. That portion can be depreciated on a 27.5-year period. Land can't be depreciated at all. As a result of that, in the first year, Pistol Pete ends up calculating for his client $2,700 building depreciation. Our solution is the component land residual method. Our system is designed to dramatically increase your valuable depreciation deductions by looking at cost segregation and taking it into an even higher level. We allocate the property cost first to those components that give you the largest deductions, down to either a low or a no land value. So if you look at this slide, you'll see that what we want to apportion first to is personal property, which gets to be depreciated over a period of 5 years. Next, we move to land improvements, which get to be depreciated over a period of 15 years. Following that is the building, which gets to be depreciated over either 27.5 years for residential or 39 years for commercial. And then land, which you don't get to depreciate at all. By following this method, you're going to generate larger non-cash depreciation deductions more quickly. So the first thing we're going to talk about is personal property. That's written off over 5 years, and as a result, it results in a 6-time higher deduction. The second component, written off over 15 years, again, almost twice as fast of a deduction. All right, so here are some of the land improvements. These are exterior things, curbs, drainage, landscaping, pavements, anything outside, lighting, etc. Next, we move on to the building. And last, we run into land, which we want to put as low a value as possible onto land. Now, I also am frequently asked to represent people in audits because lots of CPAs are not comfortable dealing with the IRS. One of the things I can tell you while looking at this is that in all of the real estate audits that I've handled in the last 6-8 years, I cannot think of a single one where the auditor actually evaluated the depreciation calculations. So this does not seem to be something that auditors are focused on typically. So, you know, we're going to go back to this 80-20 way. Pistol Pete would have come up with $2,700 in depreciation. In our system, we're going to take all these and break them out. Now, instead of $2,700, in the first year, you're going to get a $6,100 depreciation deduction. You know, more than double the $2,700. In your second year, it's $8,600, basically almost triple, with similar results for the next 3 years. That gives you the ability to pay less in taxes. I hope you're as excited about this as I am. You know, think about this. If you have a $3,000 tax savings and you save that for 5 years, that's $15,000. And if you make a good investment and you buy the right types of investments and you get a 20% return on that, you could have $37,000 accumulated over 5 years. These calculations are for only a single $100,000 properties. Add the zeros, you know, buy bigger, more expensive properties and see what happens. If you were to have 8 $100,000 properties or one $800,000 property, the first year's depreciation would end up being $65,000. If someone's in the top tax bracket and they have a $65,000 deduction, that generates $26,000 in tax savings that otherwise would be spent by paying the IRS and the tax man. So you are way ahead of the game when you use our component residual method. If you look at this example, you've got other income of $65,000. If you've got component depreciation of $65,000, it ends up zeroing out your income. You're going to put $26,000 in your pocket. So let's talk a little bit about the properties that we've got. So these are things that are personal property that you can write off over 5 years. All sorts of appliances. Moving on, things that are external, blinds, drapery, shades, or internal, awnings, antennas, carpeting. And these items, as you see, all of these in purple, these are tax law citations. So in the event that you would be audited, you can point to these tax law citations and give to either your representative or the auditor. Moving ahead, you see lots, again, more of the personal property schedule that's included in the program that we provide. Other things, generally, that you have, kitchen cabinets, shelves, carpeting, lighting. I mean, all of these things are considered personal property, even though under most state tax law, if they're attached to the building, they're considered real property. The state real property law does not control. The IRS sets its own rules with regard to what is personal property. And one of the key components is, can you move it? If you can move it and you're not changing the structure to any significant degree, generally you can treat it as a piece of personal property. Things that you can move theoretically, which are not personal property, would be something like a water heater or a furnace. Those things, even though theoretically they can move, are part of the main building system. So my buddy Al said, don't nail it down. Instead, you screw it while you to the IRS. So we'll move on into some additional personal property amounts. So you can see interior walls, as long as they're non-weight bearing, are considered personal property, shelving, garages, self-storage. You see all of these items. So now I want to move on to a case study. A fellow named Angelo Guerrera. He was a real estate investor and needed some deductions. He was sending 4 girls to college and needed to save some money. He had a CPA for 25 years who had never heard of componentizing. He refused to assist with it. Angelo ultimately fired the CPAs and did the componentizing himself using our Renaissance Goldmine land residual system. As a result, in the first year, Angelo saved $20,000 on his taxes, which went a long way towards helping cover his daughter's college education. And he also got rid of a CPA who wouldn't listen. Here's a testimonial letter that Angelo sent out. Your course saved me almost $20,000 in taxes. The item was componentizing. Based with the info from you, I proceeded to request my CPA of almost 25 years to use this method. After much discussion, I elected to obtain a letter from the IRS stating that your method was an accepted way of calculating the depreciation expense. So he was very satisfied. Think about it, $20,000 a year, if invested at 10% over the next 10 years, would accumulate to $318,000. That is the wealth building effect of our system. Knowing the tax law will make you wealthy faster. You know, besides increasing your cash flow, there's even more to the miracle of componentizing. When you acquire a property and you componentize it, and then you are doing improvements, what you're allowed to do then is what's called scrap the old property. So for instance, if you have kitchen cabinets that you originally think had a value of $8,000 and you spend $22,000 on new kitchen cabinets, you have the ability to write those original $8,000 cabinets off. In essence, you scrap them, you take an $8,000 loss, and then you would begin depreciating on a 5-year life the new cabinets that you paid $22,000 for, the deductions up front. And think about this. When you do this, you can also use this method to exit your property with a 1031 exchange that we're going to talk about shortly. The magical power of the real estate tax shelter ultimately is the ability to defer and not have to pay taxes at all during your lifetime and even after the death of you and your spouse. Here's another letter. Dear Bill, using componentizing, I already saved $2,000 on only a $30,000 property, my very first deal. Thank you so much for this valuable information. Jim Onesti. By the way, if your accountant has not componentized and used this method, you can go back and recalculate your depreciation based upon this method. And you can go back more than 3 years. You can go back as long as you own the property and then take all of the depreciation that you had missed all in the current year. And we've had clients who've reaped $5,000 to $80,000 in tax-free cash as a result of changing their depreciation method and having owned properties for an extended period of time. When you do it right, it does not increase your chance of an audit at all. It is absolutely legal and permissible under the Internal Revenue Code. With the system that we're going to give you, you can do this componentizing yourself. You do not have to pay some kind of cost segregation expert. Ultimately, it's componentizing to monetize, giving you huge tax savings. Again, I talked to you about deducting property components that are replaced through what we call a gut out, or when you're pulling out properties, the example of the $8,000 cabinets that are being replaced. How you can take depreciation deductions even if your property is vacant, and how to audit proof while you're doing this component residual land method, and many more things. By the way, this information that I am teaching to you has been in the what you'd call the domain and aware of by knowledgeable CPAs for decades. What's interesting is that the IRS has released new what are called repair and capitalization rules that I believe require you to componentize in the future, beginning in 2015 and beyond. So if you've got someone who has not componentized and hasn't discussed this with you, you might want to ask yourself why they haven't. Another goldmine strategy that we have for rental property owners is to sidestep your passive loss limitations. This allows you to be able to fully deduct the paper property tax losses that you've had against the other income that you earn. So the general rule is that if you've got rental losses that exceed $25,000, or to the degree that your adjusted gross income exceeds $150,000, that you cannot reduce the adjusted gross income that you have. You can't net out your rental losses against your other income. they'll say that you can't do it based on the passive loss rules, and that can cost you thousands and thousands of dollars a year. We've got a solution. It's the unlimited loss deductions without any cash outlay. The thing that allows you to do this is the Revenue Reconciliation Act of 1993. And ultimately, just to give you a background on that, that was about the time that Congress wanted to improve the real estate market. Late 80s and early 90s, the market had gone bad, and so they said these passive activity loss rules should not apply to people who are actively engaged in real estate. So they allowed those who are what are called real estate professionals to deduct their real estate losses against their other income. It's a wonderful, wonderful tool for you to use to reduce your taxes. But you have to know how to do it right so that you don't get audited for calling yourself a real estate professional. What's critical here, and the critical component, is that you must document the hours that you have. So basically, you've got to keep track of your hours, and we keep track of those hours with specifically designed forms to document that you're active and not subject to the passive loss rules, and this is in accordance with IRS regulations. These forms should be filled out on a weekly basis, and I'm going to show those forms to you in a moment. And the reason that we want you to fill these forms out on a weekly basis and then maintain them is they are the gold standard to the IRS. They are called contemporaneous written records. When you have contemporaneous written records, the IRS has almost no ability to challenge them. So let's talk about the first form that we've got. It's called a weekly summary of real estate business activities. So these are the types of activities that you will list and identify, the type of work that you're doing and the type of activities that you're undertaking. So you would fill these forms out. It's really a two-page form. And then sign it and date it on a weekly basis, putting a total in place. We have a second form, weekly summary of management activities. Again, a similar form showing the activities you take as a property manager. You simply have to fill in numbers here. You put an hour here, 2 hours there, 3 hours there, whatever the case may be, whatever you think is benefiting your real estate activities. And by the way, these don't have to be limited to actually on-site things. For example, time that would count would be looking at multiple listing services to try to establish values of properties, looking at property transfers, again, trying to determine property values, evaluating certain neighborhoods, even things such as reviewing police activity or police blotters when you read the paper. That time counts as well. Again, you would fill these forms out, sign them and date them, and now you have a contemporaneous written record, the gold standard of the IRS. So I'm going to give you an actual case study now. I want to tell you about Michael Mazzotto in our case study. He was a full-time air traffic controller. He wanted to fully deduct his property tax losses. His CPA said he could not because he had a full-time job. But once Paul saw our log documents to track his hours, he said this can be done. As a result, Michael saved $13,000 in just the first year by documenting the required number of hours using our forms. You know, the three most powerful weapons in defending yourself in an audit are documentation, documentation, and documentation. You got the documents, you win. You don't have the documents, you lose. So this is the gold standard in defending yourself. Again, if you did get audited, we're going to teach you also ways, as I said all along, to avoid the possibility of that audit. In order to be a real estate professional, a special election has to be made, and we have a specifically designed audit-proofing statement that we attach to the return to safely claim the real estate professional status and fully write off your rental property losses. We have more techniques to document all of those necessary hours. So now we're going to move in and talk about people who are more active in the acquisition and disposition of properties, whether it's wholesaling, acquiring, remodeling, and selling, whatever kinds of more frequent transactions of flipping. The first thing you have to do to avoid paying the government a huge amount of money is avoid being what's called a dealer. So people always have trouble understanding the concept. Under the Internal Revenue Code, you can be either a dealer or an investor. So Let's talk about that. Generally, dealers, and by the way, you can be a dealer in something other than real estate. You could be a dealer in cars. You have a used car lot. You could be a dealer in fruit. You go to the farm and then you go to a farmer's market and sell fruit. You'd be a dealer in fruit. Dealers basically buy low and sell high. That is the idea of a dealer. Dealers are the equivalent of day traders, but obviously with a longer time horizon. Dealers buy with the intention of not holding for long-term investment purposes. Conversely, investors are people who generally buy with the intention of holding for a longer period of time and intend to earn money through property appreciation. So investors are buying properties with a longer time horizon than dealers. So you want to be an investor. And the first rule in being an investor is treat yourself as an investor. Call yourself an investor. You are not a dealer. You are not a flipper. You're not a wholesaler. You happen to be an investor who occasionally may buy and sell a property when the opportunity arises. So now that you understand the difference between being a dealer and being an investor, I want to explain why being an investor is so much more beneficial. Investors get to sell properties, and when they sell properties, they get to pay out the capital gains rates, which, as long as you hold a property more than a year, are either 15 or 20%. Investors don't have to pay Social Security or FICA or Medicare self-employment taxes. Investors are allowed to dispose of a property using a 1031 exchange so that they don't have to pay tax on the gain. Investors are also allowed to sell tax-free using a self-directed IRA. Investors are also allowed to basically take back paper and report their gain as the person buying the property pays them. That's called an installment sale. Unfortunately, as you start buying and selling properties, often CPAs will treat you as a dealer instead of an investor. I'm going to explain to you why that primarily happens. The primary reason is it is much easier to do the tax return for a dealer than it is for an investor for this reason. Dealers can basically throw all of the expenses for all of their flips into a single bucket and then report all of their income from a single bucket. In essence, you might have 7 flips in a year, and you report a single amount of net income from all of those flips. You don't have to itemize the expenses. On the other hand, investors have to keep track of their income and expenses based upon the property. So if they flip 7 properties, they have to separately report the income and expenses by the property. It's a little bit more work for the accountant, and so for them, it's easier to treat you like a dealer. If you are holding inventory, if you ask your accountant if you're holding inventory, you are a dealer. Dealers hold inventory. Investors capitalize their assets, and they're treated as depreciable assets. You know, the downside of being a dealer, you pay at the highest tax rates, ordinary tax rates. You must pay self-employment tax. That's FICA and Medicare tax. You're going to be much more likely to be hit with the alternative minimum tax, the Medicare surcharge. All kinds of taxes are going to chase you down. You don't get to use the installment sale treatment, so that if you sell property on something like a land contract, you have to pay tax on the agreed sale price, even though you haven't been paid all of the cash by your buyer. So you have to, in essence, prepay the tax when you take back paper. It's nearly impossible to be able to be a dealer and do installment sales. Ultimately, being a dealer is truly like being condemned to hell. There is no bright line test. There is no test whatsoever in whether you're a dealer or not. Understand that. The biggest thing you never want to do is call yourself a dealer. And by the way, if your accountant has recommended that you are buying and selling properties through an S corporation, they likely, very likely, have decided that you're a dealer, and you may not even know it. Ultimately, your accountant's treating you as a dealer if you hold inventory. You are likely, if you have an S corp that you're buying and selling properties through, that you're a dealer. And the reason that they do this is that it makes it easier for them to do the taxes for you, and I think most of them think they're charging a cheaper rate and therefore helping you out. Honestly, it's penny wise and pound foolish. We're going to give you the savior, our Renaissance Gold Mine program, with research with 30 strategies to avoid the costly consequences of being a dealer, saving you tens of thousands of dollars a year in taxes. Of course, the most powerful strategy is your investment intent. There was a Supreme Court case that William Mallet, it said that if your primary intent is to be an investor, then you are not a dealer. Say you're an investor and you are 90% of the way there. This is a Supreme Court case. It is the highest law of the land. So we've created this statement of investment intent that you should include in your business plan and include, if you've got an LLC, in your operating agreement. For all properties that I acquire, it is my primary intent to keep the property for investment and rental purposes, along with long-term capital appreciation. I will only sell the property if my original primary investment intent is changed by unanticipated events, generally beyond my control. Do you hear that? Changed by unanticipated events. So what's an example of an unanticipated event? I need money. That's called working capital. I need money. I changed my mind. The market changed. I've considered or reconsidered an investment plan. There are actually 36 liquidating factors which allow you to say you're an investor, you bought a property, and within a few months you changed your mind and you decided to dispose of it to pursue your intentions of being a dealer and the long-term strategies which exist. We further enhance your investment intent by documenting the fact that these profits that are generated by the buys and improvements or wholesaling are generating liquidity for 10 investment necessities of your rental portfolio. Such examples are having a general working capital fund so that you can manage your rental portfolio, handle unanticipated expenditures or extended vacancies. And another one is to modernize or improve the rental properties that you have to allow them to be able to earn greater rental rates on those. Ultimately, this is a long-term investment in your wealth with high profit and very low risk. The tax-saving result of our statement of investment intent: you are an investor and not a dealer because you are using the resale profits for an investment purpose, as these flips are non-dealer investment transactions. And you're relying upon the Supreme Court case of William Mallet, and in the law they would say, and its progeny, which means the 36 tax court cases that follow that rule under William Mallet. You'll save thousands of dollars in ordinary income, self-employment, alternative minimum taxes, etc. So, our statement of investment intent, which will be provided with our Gold Mine program, we want you to include it in your operating agreement, sign it, notarize it, and then audit-proof your return with it. Against the IRS, the statement of investment intent is like kryptonite. We're going to give you a case study now. This was a fella that Al worked with very frequently, John Burley. One year he sold 260 houses on land sale contracts, just kind of taking back paper with seller financing. Unfortunately, John used the incorrect forms and he got a notice of examination from the IRS. John used the statement of investment intent, citing to the Supreme Court case of William Mallet and the other cases that the tax court has relied upon. And after a tough, hard, long battle, was able to be deemed as an investor and not a dealer by the Internal Revenue Service. As a result, John saved over $200,000 in taxes, plus interest and penalties that would have been imposed had he not been able to prove his status as an investor. We're going to give you some more dealer avoidance strategies and how to audit proof to show that you are an investor and not a dealer. We're also going to teach you, if your tax preparer, your accountant, has treated you as a dealer, how to, in essence, reverse that status and in the future treat yourself as an investor. You know, once you are an investor, now you have the ability to sell property tax-free through a 1031 exchange, where you totally avoid taxes by buying a replacement property within the IRS guidelines. In this event, you get to keep all of the profits, and there's even ways to take out tax-free money on a 1031 exchange. You know, 1031 exchanges avoid capital gains tax, depreciation recapture, AMT, etc. This amounts to thousands of dollars that can be invested in more income-producing properties or to invest and fix and flip more properties to grow your wealth exponentially. And with our goldmine tax planning strategy, wholesalers and rehabbers can do 1031 exchanges on their flips. Absolutely, rental property owners can do 1031 exchanges on their flips. So I want to tell you a little bit now about the beauty, understanding how not to be a dealer, how to invest in properties as an investor, how to use 1031 exchanges. So we have a client who's a fourth-generation real estate investor, and he was mentoring a young fella who was starting to build a nice amount of equity in his real estate. So the young fella said to his mentor, Bob, so Bob, what is my exit strategy? And my client, Bob, astutely responded to the younger fellow, you die. I hope you're laughing at that one. Here's the reason for that, and this is what you need to understand, is that ultimately you have the ability through doing 1031 exchanges to grow your wealth without having ever paid taxes. So in theory, you could start out with $100,000 of equity and over 30 years build up to $8 million worth of real estate equity. And if you did a 1031 exchange every time you disposed of a property, you would now have a capital gain of many millions of dollars. I don't want to get into complications, but just understand, let's call it $7 million. So after 30 years, you're an older person and you are considering selling the property. If you sell the properties, you're going to pay tax on a $7 million gain. On the other hand, if you do not sell and you die owning the properties, your heirs will own the properties, and if they were to sell them immediately after your death, they would pay no tax on the gain. The reason for that is a thing called the stepped-up basis rule. The stepped-up basis rule says that when property is inherited upon death, there are no capital gains taxes due. That what's called your taxable basis increases to the fair market value of the person who's died at the date of their death. I had a client one time say to me on a 1031 exchange, well, we're just deferring the tax. We have to pay it someday. That client didn't understand the stepped-up basis rule. The fact of the matter is you never have to pay tax on the gains if you exploit the stepped-up basis rule. So, you know, some people say to me, hey, Bill, I got to live. You know, I need money. What if I don't sell? So here's the thing. You can do a 1031 exchange, and you can refinance a property and take cash out. That is not a taxable transaction. Cash out refinancing when you hold properties not in a corporation are not considered to be a taxable event whatsoever. So you can do a cash out refinance, borrow money to live, use that money, and never have to sell a property and recognize a gain. The way I explain it is buy, hold, exchange. Buy, hold, exchange. Exchange, exchange, rinse, repeat, like they said in the shampoo commercials. Ultimately, the exit strategy, you die with your heirs having a multi-million-dollar portfolio. And meanwhile, you have extracted cash through refinancing for your life. I hope that excites you as much as it does me. So we're going to teach you now about our program that's available for you to acquire today. It's the Renaissance Goldmine of Tax Strategies for Real Estate Investors. This is a program that includes both written materials and audio CDs, covering all of the materials that we've got, plus even more. So this system is a reference library where you easily look at the applicable goldmine strategy just by clicking on it. So audit strategy 3, audit proofing your returns. Next strategy 6, componentizing, how to write off and depreciate your properties using that method. Strategy 12, how to avoid our passive loss limits, as we talked about by being a real estate professional. Strategy 23, total dealer avoidance. We also show you The right forms to report your sales transactions so you are not a dealer and have a very low audit profile. Strategy 31, how to use self-directed IRAs, when they're good to use and when they're not so good to use. Strategy 25, using 1031 exchanges to avoid taxes on the sale of your properties. We talk about strategy 20, loss year planning. Sometimes if you have losses, you don't want to utilize deductions in those years, and we teach you how to do that. So here's a testimonial from Nancy. I'm so glad I got your tax system when I did. My former CPA would have taken about $20,000 in deductions, and I did not need it all. The wasted savings would have been over $4,000. With your gold mine, I am able to use these deductions in the future when I need them to reduce my taxes. We're going to teach you how to avoid depreciation recapture with Gold Mine Strategy 24, how to handle seller financing and the best strategies for that with Strategy 26. It includes when seller financing is a good idea and when it's not a good idea. It also talks about how to get all of your tax-free cash, even if you take back paper, and how to convince a seller to do seller financing. This allows you to avoid banks, loan officers, etc. We're getting even more tax-saving gems that CPAs don't know about. A testimonial letter from a CPA. I am a CPA, haha, and real estate investor. And I agree with everything you say about CPAs and taxes. I never do most of what you're covering in these CDs. You're going to save me a bundle in taxes. This is Cynthia Gordon-Nix. So we're going to show you tax reduction planning and audit proofing for every type of real estate investing, including the high profit, low risk strategies that we've been talking about today. You're going to learn about how to eliminate or reduce the AMT, like a student of ours who saved $14,000, and how to reduce and eliminate the Medicare surcharge. There are hundreds of tax-saving strategies that you can use throughout the year. This book is not a cover-to-cover read. What you do is you look at the table of contents to see the strategy that you'd like to see. You turn to the papers. You can read it. It's cross-referenced to the audio portions of the CDs, so you can listen to the audios as well. Every one of our strategies is supported by tax law citations. And this is not a cover-to-cover read. You use it when you need it. It's exciting. We have action plans, so it includes how to do things, not just a theoretical statement of the tax code. We have sample filled-in forms with step-by-step instructions to teach you how to implement these strategies yourself. By the way, these aren't forms that you can get from your CPA or TurboTax. These are created with our system. Plus, you've got the audio CDs that track and cross-reference the written materials. Plus, we've got several benefits for those of you who are excited about this program today. So let's talk about that. The first one is we are offering customer support. What that means is you can email your questions to us regarding your taxes, and we will answer your questions. These are prompt responses. I'm the person who answers the emails with regard to your tax questions and your real estate investments. We also can assist you with, ultimately, as we said, hard to find real estate CPAs. We can help you identify those types of CPAs that understand these materials. These are CPAs that know our system, they're competent, they have great customer service, and are ethical. This is for the benefit of you as our student, to save you a lot of time and money. Unfortunately, as a class of people, real estate investors are really small for population. You know, very well under 1% of the population are involved with real estate. And for that reason, from a business standpoint, it does not make much sense for the typical CPA firm to devote the time and resources necessary to learn all of these strategies for real estate investors. So most of them just decide from a cost-benefit standpoint that they don't have to worry about it because they're not going to have many clients who are involved with real estate. The next benefit that you get if you acquire our Renaissance Gold Mine program, of course, is that you can use this Renaissance Gold Mine in conjunction with your CPA. So they can rely on this, and they can send me emails as well. Look, just think of all these additional values in addition to simply the materials in the gold mine, the written materials, the audio materials. We're offering you support. Those benefits alone are worth $2,700 very easily. There's 3 ways that you can dramatically benefit from this program. If you're someone who likes doing your own taxes without a CPA and saving on accounting fees, you can use this program and do it yourself if you're someone who's comfortable doing your taxes. The next thing is you can share your system with your present CPA. They certainly would have access to follow up with questions as well. And then lastly, we'll refer you to a CPA that understands our system. Plus, we have access to other experts. We can get you in touch with 1031 exchange experts, talk about debt reduction, ways to get zero interest unsecured loans. You will get a certificate proving that you've acquired the program, which allows you to take advantage of all of these materials. So our price for the Renaissance Gold Mine itself is $1,995, and you're going to get all of these additional materials, including the email support, the support to your CPA, directions to a CPA that understands these materials. Ultimately, think about that. That's $2,700. You know, if you were to pay for that all separately, it'd be $4,695. But we're going to drop the price. $1,892 compared to saving thousands of dollars every year on your taxes. And of course, this program is fully tax deductible. You see that we have tax law citations showing why it is tax deductible. We've got, of course, a receipt with an extended tax law citation. So now we're going to drop the price from $1,892 to $1,292, saving you from thousands of dollars in all kinds of taxes. If you're someone who's got an S corporation and you're flipping, you are probably in the worst of all boats and can certainly benefit from this. And we are going to give you these materials while reducing and almost eliminating the chance of you being audited. I've been working with people who have used this program for over 10 years, and only once or twice has a person been audited. Both of those occasions, they were audited for reasons absolutely unrelated to real estate. So the chance of being audited using these methods is remote, to say the least. Here's a testimonial. I got my money back. Less than 90 days. Just as good, maybe even better than real estate, from Tim Van Rippen. Here's another testimonial. Bill, I saved $9,000 in taxes this year on just 3 rentals using your methods. You are amazing. It's a buddy of mine, Vern Schmid. Another, I've personally saved many times the cost of the course in such a short time, with many more testimonials. Plus, we're going to talk to you about some of the top speakers who have utilized these programs and had us speak at their events. Lou Brown, Robin Thompson, Scott Shield, Dave Lindahl, Bill Bronchek, and others. There's no question on real estate tax law Bill Knoll cannot address. He has consequently saved many investors and landlords thousands of dollars. That was from Mr. Landlord. Bill Knoll's considered the #1 speaker on real estate tax strategies in the country. You know, ultimately, either way, you have 2 choices on how you're going to pay. You pay the IRS thousands of dollars every year, or you can buy the gold mine and pay Bill a lot less, one time. Okay, this event only, we got the price to $997. That will be the price. It includes the email support, the references to gold mine experts, the license for your CPA to use it, and to send emails. Of course, we've got the tax law citation, making this a fully tax-deductible expense. Nowhere else are you going to find this. By the way, we do not offer this program through an internet website or any other such place. It's only offered through this program and this webinar right now. Now, because you guys have been such a great audience, I'm going to offer a few more bonuses. The first bonus is I'm going to give you an additional 6 months of support. Now you've got 1 year to email me the questions that you have related to the gold mine strategies and your tax problems, so that we are not going to just sell you a book and leave you hanging. We are going to support your endeavors in growing your real estate wealth, and I mean that sincerely. We want you to be successful as real estate investors, not dealers, and increase your after-tax cash flow. Look at this. Look at the values that we're saving. Now, this is for the first 10 people that are going to buy the program today. So here are the bonuses. We've got an additional bonus, and this one is spectacular. We've talked about componentizing. Now we're going to give you our quick componentizer, which is an electronic system that allows you to componentize your properties following our methods in less than 10 minutes, saving you thousands of dollars every year. You'll be able to pop the price of your property in, and out comes the various components that you're now able to depreciate. Again, creating depreciation at double and triple the method that the old-fashioned Pistol Pete would utilize. You just insert a couple of items, and all of a sudden your depreciation components are calculated. For example, on your $100,000 rental property, here's what you're going to see. Personal property, $15,900, land improvements, $10,006, building, giving you total component depreciation of $6,100. Remember, if you had an $800,000 property, look at the money you'd save. Component depreciation of $65,011 using our quick componentizer that's going to be part of our program available today. Within minutes, you're saving thousands of dollars. We're giving this to you as part of our program. Again, only for the 10 people who buy today's event. Now, I mentioned to you previously, if you are someone who has listened to these materials and think I have some idea that I know what I'm talking about after being involved with, the law and taxes for, well over 25 years, for those of you who buy the program today, you will be eligible to send me your last 3 years' tax returns, and I will review them for you and with you and discuss them with you. My review will include an analysis of whether your tax returns have been done properly. I will also look to see if there's the possibility of correcting your tax return for errors. If I do locate errors, you would have the ability to amend the tax return, and I will tell you what errors would occur so that you would have the ability to amend your tax return and potentially get past paid taxes back. I do this for students, and people have saved thousands of dollars. In addition, my review of your tax return will allow me to understand the manner in which you are investing in real estate and then help pinpoint those strategies that are most useful to you as a real estate investor. Remember, there are many, many strategies that are included in our Gold Mine program, and I will review your tax returns to help tailor those strategies to your needs. In addition, while I'm reviewing your tax return, I will let you know my thoughts about the person that's doing your tax preparation. Generally, I break it down into thirds. 1/3 are butchers. 1/3 should never touch another tax return, certainly shouldn't hire the person who did their tax return again. Another third I would consider competent, meaning that they haven't done anything wrong, but the fact of the matter is that they're really not qualified to assist with real estate. And then the last third are people who I think are generally pretty good tax preparers, and some of them I say they're great, stay with them, and others of them I say they're very competent, but they don't understand real estate strategies. So that's oftentimes about the way it fleshes out. So I will give you my opinion about the quality of the work being done on your taxes. This review of your taxes covers your personal return plus any other business returns that you file for those 3 years. So if you have a partnership return, if you have an S-Corp return, all those returns I will review and look at. If you have a C corporation, I'll review that as well. That's for your prior 3 years' taxes. I will establish some baseline for how you can implement your Gold Mine strategies and save you money. I have literally reviewed tax returns and identified errors which have resulted in tens of thousands of dollars of tax savings. This is free found money that can exist from the government. I'm going to review all of your tax returns, and I'm going to also identify these strategies to audit-proof your return and identify the audit red flags that many CPAs make in doing your taxes. So I got a testimonial letter. Bill, you were extremely knowledgeable about my returns, gave excellent advice, and pointed out a grave error that my current preparer committed that could lead to an IRS audit. Thank you very much. We're also going to include with our program a sort of a little-known secret on if you haven't filed for your tax returns for several years, 3, 4, 5 years, how to implement filing them while staying under the radar and avoiding the IRS carefully scrutinizing your returns due to them being filed so late. You know, ultimately, when I review your tax returns, I'm able to review the prior 3 years because that's how many years you have to amend your return. But when it comes to depreciation, if you've owned a property for 6 or 7 years, I can actually help to establish how much you might save by recalculating depreciation using our component land residual method. And that goes back even many more years. As a result of that analysis, we have people who have gotten huge, incredible refunds. For instance, you see here some of the people that have gotten thousands and tens of thousands of dollars. Just a few more of these people who have had returns amended. Steve V got $41,000. He was a client of mine with many more tax savings. So we've got one more testimonial here. Based on your tax strategies, I was able to file amended tax returns for the prior 3 years and saved an additional $30,000. Thank you again. By the way, if you're someone who is newer to real estate investing and you don't think that you have enough information on your current year's tax return, then you have the ability to submit your returns for review for up to 2 years in the future. So that if you're getting started and you want to get a return or two filed and under your belt for me to review, you can send in the return for me to review at that point in time. You know, I'd like to remind you, just about all real estate tax returns are done wrong. Either the client is overpaying taxes due to a tax preparer really not understanding the tax code as it relates to real estate investors, or the tax preparer is raising IRS flags, and oftentimes both of these matters are happening. You know, the vast majority of you listening to this program probably have someone doing your tax returns who will not understand these strategies. This is your key to minimizing your taxes while staying under the radar. Again, these bonuses are available to the first 10 people who are going to call today. And by the way, now that we're involved with taxes more annualized, on an annualized basis, I can't always review returns quickly. So the sooner you get them into me, the sooner I'll be able to answer your questions. Look, ultimately, this super triple bonus, you're going to get the additional 6 months of tax email questions. So you've got a year. We're going to include the quick componentizer. You're going to get my free review of your tax return. I mean, my review alone, I charge thousands of dollars for people if they call me up on the phone and say, I need you to review my taxes. So I'd like to thank you all for joining me in this program today. I wish you well on your real estate endeavors. The buying of our Renaissance Goldmine program will lead you down the path to being the captain of your real estate ship and not as the first mate to your CPA or other tax preparer. I would like to thank you for your time and also look forward to those of you who buy the program getting in touch with me and me answering your questions. Have a wonderful day.